You ever panic sell when the market dips or brag about how smart you are because you got out at the worst moment? Well, here's a dirty secret. You probably missed the best days too. And those few days make more difference than you think. Let's start with a brutal fact. If you invested $10,000 in the S&P 500 over the past 20 years and stayed fully invested, you'd have about $62,000 today. But if you missed the 10 best days, you'd be stuck at $25,000. More than half your gains evaporated. Let's take a look at this chart here done by Fidelity Investments. Using the date range January 1986 to December 2024, about 39 years or so, and one initial investment of $10,000. This isn't like another 10 grand every year, just one initial investment. If you stayed fully invested in the market for that whole time period, your return would be $241,179. But now let's see what happens when you miss the 10 best days. It's down to $112,875. Keep going. Just look at it yourself. I won't read them all out, but you missed the 60 best days in the market. You only have $18,084. This shows you that playing around with the market, buying and selling, just isn't going to work. You can never predict those days. You can never predict the highs and lows. And the cue is you have to be right twice, when it's at its highest and when it's at its lowest, to buy back in. So just stay invested and you're winning. That's a killer combo of time and mistakes. You panic sell, miss the rebound, maybe buy back late. There's two wrong moves, not just one. First, you need to sell high, then you have to buy low. That's like trying to split the G on a Guinness twice. Most people can't do it. Studies from Vanguard, Morningstar, Fidelity, and Schwab all say the same thing. Stayed invested beats trying to time the market about 66 to 75% of the time. Fidelity's graph from 1999 to 2018 shows 100% total return if fully invested, but missing the 5 best days cuts it to 68%, and missing 10 best days drops it to 50%. Let me break that down why it's not just numbers, it's human nature. When the market crashes, your brain flips into fight or flight mode. Fatigue, anxiety, fear. You panic, you sell. But when it rebounds a few days later, you're not around for it. You get squeezed from both sides. First a drop, then a rebound that benefits everyone else but you. Now let's drop an analogy that hits home. Holding your cash while waiting for a dip is like standing at a bar with a full pint, but only taking one sip every 10 minutes, just in case the drink gets more expensive later. Meanwhile, everybody else is getting buzzed, making moves, living life, and you're just over there nursing your flavorless beer. Opportunity cost is real. Right now, cash savings barely earns 2% per year, while S&P averages 7 to 10% annually. Over 30 years, that's the difference between 9,000 lost to inflation versus hundreds of thousands gambled on the market doing its job. Let's talk bigger numbers. Miss the 30 best days and you shrink a 20-year, 100% return to practically flat, around 3%. Want to bet your retirement fund on guessing the top 30 days correctly? Probably not. Here's the reality. When the market drops, say 20%, it often rebounds fast. 7 of the best 10 days between 1999 and 2018 happened within 2 weeks of the 10 worst days, as per JP Morgan studies. That means every crash has a rebound close behind. If you panic, you miss it. Here's the counter. Some people say, I'll wait for a 20% dip to buy cheap. LOL. First, those dips happen without warning. Second, you can't predict when they'll end. By the time you're brave enough to buy, the bounce might have already happened. You've delayed your gains, real money you could have been compounding for years. Now let's hit emotional bias. Studies show people overreact to losses, underreact to gains. We remember the bad, forget the good. That's why we panic. But the market doesn't care about your emotions. The only emotion it rewards is patience. Here's some strategy. If you have a lump sum and your nerves can handle it, lump sum it. Statistically, you'll likely win. If you're anxious at every dip, dollar cost average into a fund, automate it. Just don't try to time anything. Stick with broad-based index funds, ETFs, or like VTI, VOO, VFE, or VTSAX, so you're not betting on single stocks blowing up or bouncing back. Tax and trading costs matter too. Every reactionary buy or sell can trigger capital gains taxes, brokerage fees, slip-ups. Staying put minimizes these. Also, rebalance, not time the market. Once a year, check your ratios, as these will move and rebalance to target. That's strategy. Trying to predict the drop isn't. Here's the takeaway. You're not smarter than the sum of every investor, analyst, robot, and fund manager out there. Your best bet is sticking to the plan, buying, holding, and ignoring the noise. So cut the crap. Stay invested. Don't panic. Let compound interest do the lifting. Because when you sit out the best days, you're basically saying, no thanks, I'll pass up free money. Time in the market is gambling, plain and simple. You're placing bets on events you can't predict, trying to outsmart algorithms, hedge funds, and thousands of full-time professionals with your gut. You might as well take that money to Vegas, and at least they'll give you free drinks while you lose it. The house always wins, and investing the house is time, not timing. Now that you know the receipts, use them. Stop timing. Just time yourself in. Your future self will thank you. So yeah, it's a Monday afternoon. We're here hiking in Whistler. It's a pretty remote hike, so we were scared of some grizzlies, brought some bear spray, but luckily we've got a bunch of other people that work serving jobs, and around. So, well, not a bunch. There's like two other people on the trail, maybe one more coming. We saw floating across the lake. It's absolutely beautiful. We paddleboard half an hour across the lake and maybe an hour hike up. That's the beauty of not working on the weekdays, eh?